What is the national debt and how much debt is too much? Welcome to Money and Good Sense. You often hear that the United States has a national debt of tens of trillions of dollars. But what exactly is the national debt? Who does the government borrow all that money from? Why does the government sometimes spend more than it collects in taxes? And is a large national debt always a bad thing? Or can government borrowing actually contribute to economic growth and prosperity? In this video, we'll explain step by step what the national debt is, how governments borrow money, why they do it, and when government debt is healthy, or when it starts to create serious risks. Because if you want to understand the economy, it's important to understand how governments finance their spending. What is the national debt? The national debt is actually a very simple concept. It is the total amount of money the federal government has borrowed and still owes. You can compare it to a mortgage. When you buy a house and borrow money from a bank, you take on debt. As long as you haven't fully paid back that loan, you still have a mortgage. For the government, the basic idea is exactly the same. Whenever the government spends more money than it collects through taxes and other sources of revenue, it has to borrow the difference. All of those outstanding loans together make up the national debt. The main difference is that the government usually doesn't borrow from a single bank. Instead, it raises money from thousands of investors, pension funds, insurance companies, banks, investment firms, and other financial institutions around the world. You might wonder why all these investors are willing to lend the government so much money. When a bank approves a mortgage, it usually looks at your income and the house you're buying as collateral. The government generally doesn't provide specific collateral for its loans. Instead, investors rely on something else: confidence in the country's economy and its future tax revenue. As long as businesses remain profitable, people continue working, and taxes keep flowing in, investors expect the government to be able to make its interest payments and eventually repay or refinance its debt. Every time the government borrows additional money, the national debt grows. If the government repays more debt than it borrows, the national debt decreases. So, the national debt is simply the total of all outstanding loans owed by the federal government. Why does the government borrow? Now that we know what the national debt is, the next question is, why does the government borrow money in the first place? There are several reasons. Sometimes the government wants or needs to spend more money today than it collects in taxes and other revenue. There are many reasons why this can happen. For example, the government invests in new highways, bridges, railroads, airports, and other infrastructure. It also spends money on schools, hospitals, national defense, and major energy projects. All of these often require enormous investments. In addition, during economic crisis, the government may spend extra money to support businesses and households. Think about the 2008 financial crisis or the COVID-19 pandemic. By temporarily increasing spending, the government tries to prevent the economy from falling into an even deeper recession. But there is another important reason governments borrow money. Many public investments provide benefits for decades. A new bridge, highway, or school may be used for generations. That is why many economists believe it makes sense that not only today's taxpayers pay for these projects, but also future generations who will benefit from them. By borrowing money, the costs are spread over many years. It is very similar to taking out a mortgage. Most families don't pay for a house all at once, because they will live in it for many years. They pay for it gradually over time. The same principle applies to the government. As long as borrowed money is used wisely and the debt remains manageable, borrowing doesn't have to be a problem at all. In the end, the real question isn't whether a government borrows money. The most important question is what the government uses that money for. Who does the government borrow from? Now we know why the government borrows money. But who does it actually borrow from? Many people assume the government simply goes to a bank for a loan. In reality, it usually works very differently. The government borrows money from investors looking for a safe place to invest their savings. These include pension funds, insurance companies, banks, mutual funds, and other large investment firms. In some countries, individual investors can also lend money directly to the government. In addition, part of the US national debt is financed by foreign investors and foreign governments. But how does the government borrow money from so many different parties at the same time? It does so by issuing Treasury securities, often referred to as Treasury bonds. A Treasury security is essentially an IOU issued by the government. It specifies how much money is being borrowed, how long the loan will last, and how much interest the government will pay. For example, if a pension fund purchases 10 million worth of Treasury securities, it is effectively lending 10 million to the US government. The government then uses that money to finance its spending. In return, the investor receives interest payments over the life of the security. When the security reaches its maturity date, the government repays the original amount that was borrowed. This allows the government to borrow money from thousands of different investors at the same time. For many investors, US Treasury securities are considered one of the safest investments in the world. Because of that, they are often willing to lend money to the government for many years. When does national debt become a problem? A national debt is not automatically a problem. Many countries have carried government debts for decades or even centuries. As long as investors remain confident that the government can continue making its interest payments and repay or refinance its debt, there is usually little reason for concern. However, that confidence should never be taken for granted. One of the biggest risks arises when interest rates increase. New Treasury securities must then be issued with higher interest rates. At the same time, older debt that matures often has to be refinanced at those higher rates. That means a growing share of tax revenue is no longer available for roads, schools, healthcare, or national defense. Instead, more of it goes toward paying interest on the debt. This leaves less money available for the other government priorities. At that point, the government has three basic options. It can raise taxes, it can reduce spending, or it can borrow even more money. If investors begin to doubt whether the government will be able to manage its debts in the future, confidence can start to decline. And that confidence is extremely important. When investors become less confident, they usually demand higher interest rates to compensate for the increased risk. That causes interest costs to rise even further. As a result, a negative cycle can develop in which a large national debt becomes increasingly expensive to finance. That does not mean every country with a high level of debt is automatically in trouble. Countries with strong economies, stable public finances, and the confidence of investors can often sustain relatively high levels of debt for many years. The real problem begins when the debt grows faster than the economy. Interest rates remain high for an extended period, and investors' confidence starts to weaken. At that point, the national debt can change from a useful financial tool into a serious economic challenge. Is the national debt always a bad thing? After everything we've discussed so far, you might think that a national debt is always a bad thing. But it's not that simple. A debt by itself doesn't tell you very much. A much more important question is, what is the borrowed money being used for? Let's compare it to a household. Imagine a family borrows $20,000 to pay for a 3-week luxury vacation. When the vacation is over, the money is gone. But the loan still has to be repaid for years to come. The debt doesn't generate anything of value and ultimately becomes a financial burden. Now imagine that same family borrows $20,000 to pay for a college education. As a result, they may qualify for a better job, earn a higher income, and repay the loan more easily. In that case, the debt helped increase their future earning potential. The same principle applies to the government. If the government borrows money to invest in highways, bridges, education, innovation, or other projects that make the economy more productive, part of that investment may eventually pay for itself. A stronger economy often leads to higher income, more business activity, and ultimately higher tax revenues. But if borrowed money is mainly used for spending that creates little or no long-term economic value, then in the end, all that remains is the debt. That is why the debate about national debt is not just about how large the debt is. It's just as important to ask what the money is being used for. Debt that is used wisely can contribute to economic growth. Debt that is used poorly eventually becomes an increasing burden for future generations. How large is the US national debt? Now we know what national debt is, why governments borrow money, and when debt can become a problem. But how large is the US national debt today? At the time this video is being recorded, the US national debt is approximately 38 trillion. That sounds like an enormous amount of money. However, economists usually don't focus on the dollar amount alone. Instead, they look at the relationship between the national debt and the size of the economy. This is known as the debt-to-GDP ratio. GDP stands for Gross Domestic Product. It is the total value of goods and services produced within the United States in 1 year. The US national debt is currently roughly 120% of GDP. In other words, the total national debt is larger than the value of everything the US economy produces in a single year. Why is that percentage more important than the dollar amount? Imagine two countries that each have a national debt of 500 billion. If the first country has a 2 trillion economy, that debt is relatively manageable. But if the second country has an economy worth only 600 billion, the exact same debt represents a much heavier burden. It's similar to a mortgage. A 300,000 mortgage may be perfectly affordable for someone with a high income, while the same mortgage could be overwhelming for someone earning much less. That is why economists usually compare countries based on their debt-to-GDP ratio, rather than the total amount of debt. Compared with many other developed countries, the United States has a relatively high debt-to-GDP ratio. Countries such as Japan, Italy, and France also carry very high levels of government debt relative to the size of their economies. That does not automatically mean one country is managed better or worse than another. It simply shows that a national debt should always be evaluated in relation to a country's economic strength and its ability to continue paying interest and repaying or refinancing its debt. That is why the total amount of national debt by itself tells us surprisingly little. Only when you compare it with the size of the economy and the government's ability to meet its financial obligations do you get a meaningful picture of the country's fiscal health. Conclusion: a national debt is not inherently good or bad. Just like with a household, what really matters is why the money is borrowed and whether the debt remains affordable over time. A government can borrow money to invest in highways, bridges, schools, national defense, energy infrastructure, or other projects that benefit society for many years. In that case, part of the cost is shared by the generations that will also benefit from those investments in the future. But a national debt also has its limits. If the debt grows too quickly, interest rates rise, or investors begin to lose confidence, interest costs can increase significantly. As a result, less tax revenue is available for other important priorities, and the government becomes less financially flexible. That is why economists usually look beyond the total amount of debt. They focus primarily on the debt-to-GDP ratio, the relationship between the national debt and the size of the economy. A country with a strong economy can generally support a larger debt than a country with a weaker economy. Although the United States has a relatively high debt-to-GDP ratio compared with some other countries, the size of the debt alone does not determine whether it's sustainable. What matters most is whether the economy continues to grow, whether investors remain confident, and whether the government can continue meeting its financial obligations. Ultimately, the national debt is simply money that is borrowed today and must be repaid tomorrow. As long as it finances sound investments, the economy remains healthy, and the government can continue honoring its obligations, a national debt does not have to be a major problem. But like any loan, debt is only wise if you can continue to manage it responsibly. I thank you for watching, and remember, don't worry too much. Everything can be overcome with study and patience.